our talk of the tape. The big July jolt. Stocks handing in a monster month. The S&P 500 rallying more than 9%. That would be its biggest gain since November 2020. So as we head into August, is an even bigger breakout building, or was July just a bear bounce? Let's ask Greg Branch, founder of Veritas Financial Group and a CNBC contributor. Greg, you weren't so excited about what you expected the economy, the market to do. The Fed gave us 75 basis point hike. What do you think happens now?
So you're exactly right. I thought a number of things would combine this week to lead sentiment lower, to lead the markets lower, and that didn't happen. On 4 of those counts, I was actually right. We saw deterioration in the home market with June sales down 8.6%. We saw second quarter GDP coming below that 1.6% growth expectation with 90 basis points of contraction. We saw PCE surge to continue at roughly a 40-year high by going from 4.7 to 4.8%. Where I was wrong is with the Fed. I thought that a disastrous CPI number would show that they had a lot more wood to chop in terms of their aggressive fighting of inflation, quote unquote, and they decided not to do that. So I don't think that a 75 basis points rise at this point, when it's well signaled and well anticipated, is going to go very far in terms of aggressively fighting inflation, and the numbers are showing that out. So when you send the signal, as the Fed has done, to put risk back on, that's what the market's going to do. And I think that's the signal that was sent. I think that will be the modus operandi of the market for a while.
Well, yeah, but what's a while? I mean, that's important, right? I mean, July, we might as well say it's in the past, right? From a market perspective, It is. So do you expect, at least for August, that to continue, maybe even for the rest of Q3 until we start getting, Q4 numbers? There's got to be a lot riding on what the consumer is going to do there. Perhaps the reality check you're looking for sets in?
I think a while is a few weeks. If you want me to be more specific, at the end of the day, what's going to happen is that we're going to get those July numbers in late August, so around Jackson Hole. And I think what the Fed will see is that maybe pushing the brakes on a program to fight inflation and going on an ad hoc basis or a one-off basis or being quote-unquote data-driven was probably not the right signal to send. So I think that we'll have another round of eye-popping inflation numbers. And you got to remember, these inflation numbers aren't off of easy compares or low compares. These are off of 4 and 5% that we were experiencing last year. And so I think that while the market is pricing in a Fed pivot, a more dovish pivot at this point, I think that we'll see the Fed change its tone in late August, which I think will change the market tone, particularly as we get evidence that the supply chains are still in quite a disrepaired shape, and as we get evidence that inflation is still a concern.
So if the markets are operating, as you say, on some wishful thinking, what is it that investors should be buying in early August while a few weeks is still operative before the reality that you expect sets in?
So at the end of the day, whether you're buying companies now or you're buying companies 4 months from now, we're looking for the same thing. We're looking for companies that have sustainable demand that is tethered to a secular tailwind. And so one of my concerns, as you know, is that the consumer balance sheet is deteriorating. The consumer is levering up at a time that it's historically expensive to do so. And so you want to look for companies that have a rock-solid demand line that, quite frankly, might be insulated from any weakness in consumer demand going forward. You want to look for companies that have protected margins, where the continued persistent inflation that we're expecting, and by the way, I expect this to end this year north of 6%, that is not so meaningful as it is to other companies. And those two things combine to give you consistent earnings growth. And that is the secret sauce. That's what we're looking for going forward, whether I'm right or whether I'm wrong. That will drive performance without any multiple expansion.